The stock market is down big in 2022, so why should young investors love bear markets? Today we're going to discuss what you can do to take advantage of it. Stay tuned. Hey there, it's Alex and Matt from One Degree Advisors. Today we're discussing a bear market here in 2022, and we're talking about what younger investors should be doing to take advantage of these market conditions. I mean, Matt, it's no surprise. It's human nature, right? We don't like it when the stock market's going down. We get that thing in the mail, our quarterly statement. We open it up going, oh my gosh, my 401k, brokerage, whatever is down 10, 50, 100,000 bucks. What the heck is going on? But today we're talking about for younger investors, and maybe not just younger investors per se, but those that are still contributing and they're still putting money away. Why contributing in a falling market over time can be a good thing.
Yeah, and this might sound a little bit counterintuitive, but if you're a younger investor and you're contributing, this is actually something you can take advantage of. And let me show you a visual why, okay? So if you're taking a look at we got stock A and stock B and two different market conditions, right? Stock A, the market's hot, it's a bear market, and stock B, the market's a little bit in the red, it's falling, right? So over time, if you're going to invest $100 a month for the next year, it's as simple as stock A, you're buying at a more expensive price, and stock B, you're buying at a cheaper price. So eventually, when you get to the future, stock B, you've bought at a lower price.
You have more shares of stock B.
Exactly. It's as simple as that.
Yeah. And again, this is under the assumption that over time markets average out. So if we can't agree upon that assumption, then this illustration doesn't work. But if history is any a provider of what's going to happen in the future, we can say, hey, this can be a good thing over time. Now let's talk about how folks can take advantage of this. And really the first thing is dollar cost averaging. I mean, this is what I think most people are most familiar with, right? This is like your 401k, every paycheck, you're putting money in. To be quite honest, I mean, you're contributing whether or not the market is high or low. So if you're putting money in, again, putting money in every single paycheck when the market's low, that can be a good thing. You're buying more shares.
Yeah, what I like to call is putting your money on autopilot, right? Putting your contributions each month or each quarter on a consistent basis. If you have the right investment plan, this is a great option because you're not trying to time the market. You're not, waking up every morning, looking at the newspaper and say, oh, I'm going to put my money in here today. No, you're setting it on autopilot.
Well, because the other thing too is that the newspaper and the news outlets will never give you the all clear sign, right? They
never.
Like to sell fear, uncertainty, and doubt. All right, second thing here is rebalancing. So you really should have an investment plan, and that means targeting a certain level of risk that aligns with your risk tolerance, goals, age, all that good stuff. But here's the problem is over time, life gets in the way, right? It's just life, markets change, your life changes. So what happens when those targets get out of whack?
Right, when those targets get out of whack, whether the market just takes off and you're in a bull market, sometimes you want to rebalance back to the plan, which basically means taking a little bit of profit off the table. And right now what we're seeing is the market's in a little bit of a drawdown where maybe it's a good time to reinvest and go back into your investment plan and get towards more growth.
Get back to that target.
Yeah, exactly.
Yeah. And rebalancing should really be a consistent practice over time. It's a disciplined approach. It shouldn't be, like you mentioned earlier, waking up one morning and saying, well, what should I invest in? Or should I rebalance today? And we did post a video of this last year, closer to the top of the market. So that's a good video to watch that people can click on above. All right, last thing here, lump sum. So there are plenty of folks, and maybe you do have some extra cash to invest. Could now be a good time to put that money to work?
Right, and let me give you 2 points here, okay? Number one is in favor, okay? So yes, you have a lot of cash, and maybe it's time to invest. You're not trying to time it, right? You're going to go through and
no one can perfectly time the bottom.
Exactly. No one can perfectly time the bottom. And, looking at today, we're down, it looks like double digits. So, and a reason against that is, some of the money you have is short-term money. It's your emergency fund, cash reserves. let it stay in that bucket. You know, you don't want to necessarily take all that money and throw it in risk assets.
Right? Yeah, you don't want to necessarily deviate from your plan, right? Just to put some meat on the bones here. Let's say you have 6 months in an emergency reserve, right? And you see this market down. Maybe you don't go, well, I'm going to blow out my emergency reserve because I see the market's down, right? That's just being greedy, and that's deviating from the plan. Have a disciplined approach. Follow the process. Over time, that's what works well for folks over long periods of time. And like we mentioned earlier, I mean, if your portfolio is out of alignment with your investment plan, it can be a good time to rebalance. And we made a video on this back at the market peak in 2021. We recommend watching that. It gives people a good grounding and understanding. And now let us know what you think. How are you reacting to this bear market in 2022? And if you're a younger investor or still contributing, what are you doing to take advantage of it? Leave your thoughts in the comments below. And if you enjoyed today's video, please like and subscribe for more. Thanks for watching.